Hello, everyone. This is Dr. Paz, and welcome back to another virtual classroom. My apologies for the lateness in this video, but I was in the hospital for a few days with some issues, so I just wanted to make sure I got you this. And keep in mind that all virtual classroom videos will be accepted late with no penalty, because I know it's difficult to work through everything and it's difficult to get through everything. So I totally understand. And so this week we are still covering our chapter 3, the adjusting process. And let me go back into this module. And you have a test this week as well. And this is the virtual classroom, and several of you have already participated in the discussion, but let's go over that, right? So you want to make sure that you post your initial post here of 150 words and at least respond to 2 others. And you're looking at this particular scenario, and it's an ethical issue. So we have a small engineering firm that built high-tech robotic devices for electronic manufacturers. And one very complex device was partially completed at the end of 2016. So Barb McLaurin is the head engineer, and she knew the experimental technology was a failure, and XM would not be able to complete the $20 million contract next year. However, the company was getting ready to be sold in January, so she told the controller that the device was 80% complete at the year end and on track for successful completion the following spring. So what the controller did is they accrued 80% of the contract revenue at December 31st. 2016 in this case, and then McLaurin sold the company in January of 2017 and retired. By mid-year, it became apparent that XM would not be able to complete the project successfully, and the new owner would never recoup his investment. So you're going to post an initial response to the following prompts, and you can always put your personal experience in your response. That's always welcome. So for complex, high-tech contracts, how does the company determine the percentage of completion and the amount of revenue to accrue? And what action do you think was taken by XM in 2017 regard to the revenue that had been accrued the previous year? And so basically here, keep in mind when we're thinking of percentage of completion, we also have an offset, which is completed contract. So these are 2 ways in which we actually record transactions of this kind. So percentage of completion and completed contract, and that's what was done here, the percentage of completion. But also keep in mind that GAAP, generally accepted accounting principles, provides us with information that if you know something is not going to be successful, that we have to write it off, right? So it looks like if we had accrued the revenue and it's not able to be delivered, then that revenue is going to have to be reversed. So just keep these items in mind as you're answering this discussion forum. So hopefully that provides a little bit of help in here. And then RPA is like, so if we just do RPA, it's robotic process automation. And All right, we're back here. So RPA is robotic process automation. I don't know why every time I try to go to a different screen in this, it's not fabulous. But basically, this is what we're heavily doing now in accounting. We are looking at processing technology that's able to give us a lot of information. And if you just do RPA and then let's do in accounting, then there we go. I don't know why it does this every time I do this. Let's see. All right, it's still working, I hope. RPA in accounting, you'll see so many ways in which we do this. So RPA is robotic process automation, and what we're doing is we're trying to automate those tasks like the cash receipts or the cash disbursements. And so just an area, UiPath is definitely a program that I use. And so UiPath has a, here you see it, they have an educational license, and you can get one for free, and it basically shows you how to develop a bot that you can do information with. So something to check out, because it's really a fun area of accounting now, and I hope you have the opportunity to check on it and look at it. Okay. So if we go back into our modules here, let's go to our previous module, because I don't think I went over the accounting process. And so here we have several informational items. So I think I'm going to go over the PowerPoint for this lesson, and then I created this class, so I definitely want you to take a look at your handouts and your summary. Hopefully that helps you. And then definitely this demonstration problem PowerPoint will always help you with your assignment. So I always try to put in the demonstration problems, the kind of problems that you will get in your assignments. And all of these videos I also added because I definitely wanted you to have access to them. So I am actually going to download our PowerPoint and hopefully go through that with you throughout this lecture, just to help you understand Chapter 3 a bit better. And I appreciate all of your watching the video and going through it. And I would say for the assignment for this week, let's keep it simple and just go ahead and note in your assignment. Let me download this because it's taken a bit long here. And so I think I have full screen enabled, so hopefully you will see this PowerPoint. Let's see. So for this assignment, if you can add in our virtual classroom in Canvas, if you can add what you find most interesting about the chapter. So maybe add 3 things that you found most interesting about the adjusting process. Okay. So we have various learning objectives, right? Actually, let me, because I don't know if it's going to also transcribe it, but all right, we'll leave it like that. So we want to differentiate between the cash basis of accounting and the accrual basis of accounting. Keep in mind the cash basis of accounting we typically use for tax purposes, but the accrual basis is GAAP. Then we want to define and apply the time period concept of revenue recognition and matching principles. We typically recognize revenue when they are earned, and then we match revenues with expenses. We're going to explain the process of journalizing and posting our adjusting entries. And we're also going to explain the purpose of our adjusted trial balance, right? We usually have an unadjusted trial balance, then we have our debit and credit adjustments, and then we have our adjusted trial balance, and that's what we use to create the financial statement, right? And we're going to identify the impact of the adjusting entries that we complete on the financial statements. We're also going to explain the purpose of a worksheet and use it to prepare our adjusting entries in the adjusted trial balance. I am a huge fan of the worksheet. I think it's very helpful. I've used it quite a bit in industry. And then we're going to explain the alternative treatments of recording our deferred revenues and our deferred expenses. So let's start with our first learning objective, which is to differentiate between the cash basis of accounting and the accrual basis of accounting. So the differences, right? In the cash basis, it's cash, the actual transfer of cash is what matters, right? So we have that revenue is recorded when cash is received and expenses are recorded when cash is paid, and this is not allowed under GAAP. Whereas accrual basis, we record revenues when they are earned and we record the expenses when we incurred them. And this is what most businesses use throughout their financial reporting. So we have here an example, right, of Smart Touch Learning where they paid the where they paid the $1,200 for insurance for the next 6 months, and you see in the cash basis, sorry about that, don't know what's happening there. You see that you have just the $1,200, whereas in an accrual basis, you'll show the cash payment made, but then you'll accrue for each month the $200 that, because 1,200 divided by 6 is $200 a month. So you see how you have a bit more accurate picture of what's happening each month and what you're truly spending, whereas you're just recording the expense in May because you paid it, where you're only supposed to record $200 of the expense in that case. Then On April 30th, we received $600 for services that we performed for the next 6 months, and very similar, you show that the full revenue is recorded in April 30th, whereas we should just record $100 a month on the accrual basis. So now let's talk about the time period concept and revenue recognition and the matching principle. So the time period concepts is that typically most business activities, we slice into small segments of time. So we prepare financial statements monthly, quarterly, and annually. And our fiscal year is typically 12 months. And it could be a calendar year, January through December, or you can have a fiscal year end. Several non-for-profit entities, for example, close their books on June 30th. So their fiscal year is from July 1st to June 30th. And the revenue recognition principle dictates that we record revenue and the amount of revenue to record, right? So we record revenue when it's earned. It's completely different from when we collect it. And it's basically based on the selling price of the item. So revenue is usually quantity times your selling price. So if you sell your cup of coffee for $5 and you sell 10 of them, then it's a $50 revenue. So we record revenue when it is earned, and in order for us to earn that revenue, that means that the good has been delivered or the service has been performed and the earning process is complete. So typically, for example, let's take Amazon, and when I buy something from Amazon, the minute they ship it, then that's when they record the revenue because the earnings process is complete from their part, as long as I receive it. So the matching principle tells us that guides us in terms of expense recording. And expenses are recorded when they are incurred during the period. So we match the revenues and the expenses for the period. So we record, let's say, rent expense for January against the revenues that we earned in January. Even if the rent was paid in December, if it's for January, we record it in January. Now let's move on to the purpose of adjusting entries, about journalizing them and posting our adjusting entries. So here we have an unadjusted trial balance. And basically, we record adjusting entries in two different categories: deferrals, where we're deferring the expense and the revenue, or accruals, where we're actually accruing the expenses and the revenues. So deferred expenses are typically, we make advance payments of future expenses. So a deferred expense is an asset until it's recognized as an expense. And then deferred expenses are typically prepaid rent and depreciation, sometimes office supplies, but a lot of organizations take office supplies as an expense off the top. So here we have that we paid $3,000 for rent in advance, and it gives us the right to use the property for 3 months. So we would have a prepaid rent, which is an asset, and we would show the credit as cash because we paid the rent. Then to adjust the prepaid rent account on December 31st, we need to reduce it by 1/3 since the company has now used the space for 1 month. So here we're going to record the rent expense for $1,000 and not hit cash. Deferred adjusting entries never hit cash. So this is an adjusting entry. We're going to adjust the prepaid rent account to show that now we have rent expense of $1,000 that we need to record, and we're reducing the prepaid rent by $1,000 so that we have a balance of $2,000 for the remaining 2 months that we have to record the rent. Then on November 3rd, we purchased $500 of supplies on account. And as of December 31st, only $100 of supplies remain on account. So here when we purchase $500, right, then we would have, the correct way to do this entry is you would show office supplies debit of $500 and then accounts payable of $500. And then now on December 31st, since we only have $100 left, that means that we used the supplies expense of $400 of a debit, and then we're going to reduce the office supplies of by $400. So now we go on to plant assets, right? They are long-lived, tangible assets that are used in the operation, and their value and usefulness decline as we use the assets. So this is similar to deferred expenses where we paid for it when we acquired it and it's used up over time. So depreciation expense shows the usage of that asset during the time period. So here we have that we received a contribution of furniture with a market value of $18,000 from the owner. So we're going to record that as furniture because that's an asset for $18,000. And since we received it from the owner, we're going to show, and Bright is the owner, we're going to show capital for $18,000 as her equity account. So what depreciation is the allocation of a plant asset, typically property, plant, and equipment, over its useful life. So all plant assets are depreciated except land. Land is never depreciated. So there is a residual value if that is expected of the asset at the end of its useful life. So then we would only depreciate the asset. Instead of going to zero, we would go to its residual value or salvage value as it is also known. So the straight line method, what that does, that's a type of depreciation method, and it allocates depreciation on an equal amount for each year. So let's use the straight line method here. So we're going to calculate our depreciation for the month. So we have $18,000. That's what the furniture was, right? We're assuming a zero residual value, and we're assuming that the useful life of this furniture is for 5 years. So we have then $3,600 per year, but we record depreciation typically monthly. So we divide that by the 12 months. Subsequently, you could have done the 18,000 minus the zero divided by 60 months, right? 5 times 12 is 60 to get your $300 per month depreciation rate. So let's record the depreciation entry, right? We're going to hit depreciation expense for furniture of $300, and we're going to credit accumulated depreciation for furniture. Accumulated depreciation is a contra asset account, and it normally has a credit balance. We do not hit the asset account directly. So we are not crediting furniture to show it reducing. We're crediting accumulated depreciation for the furniture, and then we're going to show that on the balance sheet at the net value, which is your furniture amount less your accumulated depreciation. So the accumulated depreciation, what that shows us, since it is a balance sheet account and it's permanent, it's the sum of all the depreciation expense that's recorded for that asset, in this case furniture, up to date. I mentioned it was a contra asset account, so the balance is opposite of what it would be for an asset account. So we know assets have a debit balance, but our accumulated depreciation has a credit balance. So we have the cost, in this case $18,000, minus the accumulated depreciation of the plant asset. That's our book value, and that is what we record on the balance sheet. And so here we see that. We see the $18,000 of furniture less the accumulated depreciation for furniture of $300. So our book value is $17,700. And then we have our book value for the building. And so you may want to add that as part of your announcement, which should hopefully be $59,750. Also for your assignment, make sure that you note that land is not depreciated. That's why you see land there at $20,000 and no accumulated depreciation. So our total plant assets net, which is our book value, is $97,450 in this portion of the balance sheet. So now let's move on to deferred revenue, right? So this occurs when a company receives cash, but it hasn't really done the work or delivered the product. So it is a liability to the business because they owe that product or service or a refund if they don't do it to the customer. But then once the organization does perform or deliver the service, then that deferred revenue gets converted into sales revenue or earned revenue or recognized revenue. So let's do a transaction with deferred revenue. So on December 21st, a law firm engages Smart Touch Learning to provide e-learning services for the next 30 days, paying that $600 in advance. So the company receives $600, so we're going to debit cash, but we're not going to record the sales revenue because it's going to be performed over the next 30 days. So that would be unearned revenue, which normally has a credit balance. Then during the last 10 days of the month, we actually perform a third of those services. So in this case, we had $600, and so a third would be $200. So we're going to now debit the $200 for unearned revenue and record that as service revenues because they performed a service. Now let's move on to accrued expenses, right? These are expenses that a business has incurred, but we haven't paid for them yet. Very common examples are utilities, interest, and salaries. So let's do an accrued salary example, right? So they usually pay its employees on a monthly salary of $2,400, and half of that is paid on the 15th and half of it is paid on the first day of the next month. So in this case, you see they'll get a paycheck on December 15th, but they'll get a paycheck on January 1st as well. So let's accrue our salary. So on December 31st, we owe our employees $1,200, but that will not be paid until January 1st. So what we're going to do here is we're going to show salaries expense of $1,200 and salaries payable of $1,200. And then on January 1st, when we pay it, we're going to debit salaries payable for the $1,200 and credit cash to show the payment of the employees' paychecks. Let's accrue interest, which is another common example. So Smart Touch Learning borrowed $60,000 on December 1st, went to purchase a building, and as of December 31st, they've incurred $100 of interest expense on the note. So they're showing the interest expense of $100, and then they're crediting interest payable because they're going to pay that eventually later. Now let's talk about accrued revenues, right? These arise when a company performs a service, but you haven't yet collected the cash, or you might deliver a product, but not yet collect the cash. So when we record accrued revenues, we're typically debiting accounts receivable and we're crediting the service revenue. We just haven't received the money. So opposite of our deferred revenue transaction. So on December 15th, Smart Touch Learning agrees to perform e-learning services for $1,600 per month. And by the end of December, we have actually earned half of that fee, so $800. So at December 31st, we're going to debit accounts receivable for $800, and we're going to credit service revenue for $800. And then when we get paid from the customer, we're going to debit cash for $800 and then credit accounts receivable for $800 to show the payment has come in. And here we have two rules to remember about adjusting entries. Like I mentioned earlier, adjusting entries never involve the cash account. You have either collected the cash previously or accrued the cash, but it's never involved. And what adjusting entries do is they either increase a revenue account or they increase an expense account. So if you increase a revenue account, you usually credit it. If you increase an expense account, you debit it. So here you see a summary of all of the adjusting entries that we did throughout this activities, right? And so we see them all together here. So we notice that A through D are deferred expenses, E is our unearned revenue, our deferred revenue, F and G are accrued expenses, and H is an example of the accrued revenue. So we have covered all four types of adjusting entries in these examples. Now let's talk about the purpose and prepare an adjusted trial balance. So we start to journalize the adjusting entries, which we just did. Then we post the adjusting entries. And our last step is to prepare an adjusted trial balance. And that is what we use to complete the financial statements. So at the end of your fiscal period, we prepare the adjusted trial balance, which gives us a summary of all the accounts with the adjusted balances. And that's basically to help us ensure that total debits equal total credits. So the adjusted trial balance gives us the balances for each account after posting all of our adjusting entries, and we prepare the financial statements from this document. Now let's identify the impact of adjusting entries on the financial statements. So the adjusted trial balance basically allows us to confirm that our total debits equals our total credits after our adjusting entries. And it also ensures that the balance sheet items are properly recorded. And we use the adjusted trial balance to prepare our financial statements. If we do not record adjusting entries, then we can have incorrect amounts in our financial statements that aren't compliant with GAAP and that aren't actually correct. So here we see each of the 4 types of adjusting entry: deferred expenses and deferred revenues, accrued expenses and accrued revenues, and a description. And this is a really nice table to keep handy because you see if you're deferring expenses, you're recording the expense and you're crediting cash, which could be an asset, which could be cash. And then you're deferring revenues, you're advancing cash receipts, so you're going to debit a liability and credit revenue. And then you see at the end, you have the impact of the financial statements, right? So in our deferred expenses, our expenses would be understated, which would allow our net income to be overstated. And then in this case, since we're reducing an asset, our assets would be overstated and our equity would be overstated because we're not completing that entry. So I highly recommend you keep this handy, especially as you do your exam, because this is a great table that shows you all 4 types of adjusting entries. It gives you the adjusting entry and it tells you the impact on the financial statements if you fail to record the adjusting entry. So now let's explain the purpose of a worksheet and how we use that worksheet to prepare the adjusting entries and the adjusted trial balance. So a worksheet is typically an internal document which helps you summarize all of your data so that you have it in one nice, neat Excel spreadsheet to prepare your financial statements. There are 4 sections, right? You'll have your account names, you'll have your unadjusted trial balance, you'll have your adjustments broken down into debits and credits, and then you'll have the adjusted trial balance, which is also broken down into debits and credits. And we call this the 10-column worksheet. And here you see that. So you see your unadjusted trial balance has 2 columns, a debit and a credit. You have your adjustments that have 2 columns, a debit and a credit. And then you have your unadjusted trial balance, which has 2 columns, which gives you the 6 columns so far. Then you have debits and credits broken out for your income statement and your balance sheet, and hence your 10 columns. And so now what you see here is your unadjusted trial balance, and then you see all of the journal entries, the adjusting journal entries that we performed around all 4 categories, and then you see the ending balance. So here for accounts receivable, you see we have $1,000 and we debited it for $800, so we have a total of $1,800 in our adjustments here. And then all we're going to do is move all of these cash accounts all of these asset accounts into the balance sheet, all of these liability accounts into the balance sheet, and all of these capital accounts into the balance sheet, where our service revenue will be our credit in the income statement, and then all of our expenses will be our debits in the income statement. And we also have here an alternative treatment of recording our deferred expenses and our deferred revenue, which is part of the appendix of your chapter. So an alternative approach is that we have deferred expenses. We record it as an expense and then adjust for any unused portion. And the deferred revenues, we record the service revenue and then adjust for any unearned portion. Typically, this is not as popular. It doesn't give us a nice, neat audit trail. So I think I prefer the first methodology that we did. And I did that as a controller and as a CFO all the time because it was a lot easier to do. So here you would see your deferred expenses. You wouldn't record a prepayment or a current asset. You would just record the rent expense and then you would reduce it the next time. And then for your deferred expenses, you would have this at the end of the period. And you get the same result as the traditional approach, but the traditional approach is what most companies use because it shows you a nice audit trail. You show the payment of the cash and you show the cash as actually prepaid rent. And then when you reduce the expense, it would be opposite of this, right? Rent expense and then reducing prepaid rent. In this case, you're applying the prepaid rent at the end. And so I prefer the traditional approach, and a lot of companies are the ones that complete that. And here you have the same thing with deferred revenues. You would not record an unearned revenue account. You would show the cash and you would show it as fully earned service revenue. And then when you adjust it, you are debiting your service revenue and then recording the unearned revenue. Keep in mind that the results are the same with the traditional approach. Your account balances are the same, but I do believe the traditional approach provides us with a much more cleaner audit trail, and that's the one that we typically use. All right, so we've made it to the end of this PowerPoint, which is great. And so again, for your assignment, either note when I was talking about the assets and the land and the net balance there, you can add that as your assignment. And in addition, make sure that you note the top 3 items that were of interest to you in our chapter here on the adjusting process. Thanks for watching this video.